We're here to talk about Silicon Valley real estate market graphically and geographically, then the Greater Bay Area. Week number 7. I'm Richard Calhoun, Creekside Realty, working with buyers or sellers in Santa Clara County, San Mateo County, and Alameda counties. Here's the first data slide. What this is doing is it's comparing the active listings, the current active listings, to the median number of active listings for the same week for the past 10 years. The reason we have to do a comparison is each one of my geographical micro market areas varies in size, and so you need some idea what the raw count means, because the raw count varies quite a bit. Pink favors the sellers, blue favors the buyers. Blue would be more inventory because that gives the buyers more to pick from, less competition when they go in with the offers, and red is less than the inventory you'd expect, favoring the sellers because there's more competition, fewer homes. On the other side of the equation is the number of offers. Same concept here, except when you have a fewer number of offers, it's blue in color, and more than the normal number of offers, it's red in color, because that would favor the seller. And again, you can see each one of the different micro market areas. And again, you have to compare to some relevance for each one of the micro market areas since they change in size. Now, days of unsold inventory begins looking at that slightly different. Now we're looking at the number of active listings to the number of offers accepted in the past 5 weeks. And the reason you no longer need to compare it to the 10-year median, although I am in this slide, is because it's a ratio between the supply and demand in each ratio. But by comparing the DUI, days of unsold inventory, to the 10-year median, you can tell that the market is slower or faster than normal. A lower percentage means a faster marketplace. It's taking less time to sell all your inventory. And then in San Mateo County with the blue, that means it's taking longer, or a buyer's marketplace, because it's taking longer, especially along the San Mateo County coast, where you have 3 times the duration on the market that you typically would. Now, DUI is a theoretical number because it assumes no new listings are coming on the marketplace. And because, as I said, you don't need to compare days unsold inventory to the historical stuff. So now I have dropped the historical, and this is simply what is the current DUI, days of unsold inventory, the current speed of the market. Basically, anything under 6 weeks I consider to be a seller's marketplace. Anything over 11 weeks I consider to be a buyer's marketplace. We have 2 areas that are in a buyer's marketplace, basically the expensive areas in San Mateo County and the San Mateo County coast areas like Half Moon Bay. The rest of the area is either white, which is balanced, which would be between 6 and 11 weeks, or it favors the seller with very low numbers. A lot of these numbers are just between 2 and 3 weeks, although you do have some areas like Union City, Newark at 8 days, but we'll also see that that's a very small area, and I will try to remember to point that out. Now we're moving over to something that's easier for the layperson to understand, and this is simply the time it takes the long, typical successful seller to sell their property. What is the heck does that mean? It means how many days does it take the 75th percentile, the point where 75% of the sellers have already sold, 25% of the sellers will sell, but in a longer period of time, and what is that time frame? So you can see in Santa Clara County, it goes from basically a high of 68 days in Saratoga, Los Gatos, 32 in South County, but then you come into the heart of Santa Clara County and you're basically at a week and a half. You go down to San Mateo County and it's just slightly longer, a week and a half to 2 weeks for a lot of the areas. The coast is at 31 days, the expensive areas is at 25. You go over into Alameda County, and again, a lot of the areas are at 10 days, 1.5 weeks. Pleasanton is a little bit longer at 11, along with San Leandro, San Lorenzo, and Hayward. But then you have the standout in Alameda County at 40 days, still what I would consider to be a slightly seller's marketplace, sort of the beginning of a balanced marketplace, and that's why it's essentially white in color. Now what we're doing is looking at a metric that is sort of unique to me as far as I'm aware, and this is the average percentage the sellers are reducing their asking price. Now, this is not the typical seller reducing their house 0.5% to get it to sell. What this is something more like 10% of the sellers reducing their home 5% to get it to sell. The people that come in the market a little too high. But the average gives you a measure. It's a tight metric, which is why the range is so small. From 1/4% below asking price to 0.5% above, I consider to be a red hot seller's marketplace. And yes, obviously, if you're more than that, like at 1% or 2% above, or in the case of Fremont, 0.6%, that also would be a strong seller's marketplace. It's saturated at that 0.5%. It gives you an idea of how quickly I consider the market to be saturated. On the downward side, from 1 to 5% is a buyer's marketplace. And that may not sound like a lot, but at 1%, if 10% of your sellers are taking a 10% price reduction, that starts to be more significant. And realistically, it's probably getting to be closer to 20% of the sellers taking like the 5% reduction, because a 5% reduction in real estate is huge. But you can see the different areas. So the huge advantage of this metric is it shows you what the market's doing right now at the time the offers are accepted. Where if you look at the overbid, which we will do, that requires the sale price, which requires escrow to close. So that's lagging behind by 5-6 weeks. So this is sort of a leading indicator on where the market's going. And clearly you're either in a balanced marketplace or favoring the seller. Now we're looking at the frequency of the price adjustments. So this is how common. And you can see almost across the board, every areas are below 10%. The few exceptions are Oakland and Saratoga Las Gatos. It's North San Mateo County at 15%. So here I'm considering anything under about 17% to be a seller's marketplace, from 17 to 20% to be a balanced market with no color, and above 20% to be a buyer's marketplace. Once you start hitting 1 in 5 sellers reducing their price, I can start seeing that to be a buyer's marketplace. So you can see, as far as the frequency of price reductions, it's basically very strongly a seller's marketplace at the current time. Now we're looking at those overbids that I was talking about. And again, the huge negative of this metric is you have to wait for escrows to close. So this is telling you where the market was 5-6 weeks ago, basically the beginning part of the year. Right on January the 1st, where was the market? And overbid, this is the percent of ask price that the buyers came in above the ask price. So in Milpitas, they're coming in 7.5% above the seller's asking price on average. So you have some people coming in below. So the average of those coming in above asking price would be higher than the 7.5%. You can see in San Mateo County Coast, they're taking a 4.4% price reduction, and this is on average. So when the buyers are coming in, they're coming in 5-10% below in some cases, because there will be some overbidding in any micro market area. Foster City, Redwood Shores at 2.5%. Those are the two slow areas, and that's been fairly consistent. Here's the frequency of overbidding. So how common is overbidding? And you can see right now in Foster City, Redwood Shores, none of the transactions that closed in the past 5 weeks have been over asking price. And that's why you have a 0. So that's a very small number. 29% in Atherton, 32% in Saratoga Las Gatos, as well as South County. You can see in the heart of Silicon Valley, where the market was moving quickly, some number right around 3/4 of the sellers are getting more than their asking price. And in Alameda County, it's a number closer to like 65% of the sellers are getting more than their asking price. Now we're leaving the market conditions and just looking at where the appreciation is. Red here is the greater appreciation, blue is the least appreciation. And basically, this is a story, in my opinion, of areas that were less desirable because of the longer commutes becoming more desirable, and therefore having greater appreciation. And typically, whatever area has the greatest recent appreciation has the greatest overall appreciation because of compounding. But this is the current. So what we're looking at is the median price for the micro market area compared to a 9-month period, which was from April 1st of 2015 through December 31st, 2015. I was trying for a whole calendar year, but in our real estate marketplace in this region, we have a huge run up in prices in the first couple months of the year. And that's exactly what happened in 2015. And that gives you sometimes transactions that aren't at market value. So I was looking for a period of time with stable pricing, and I could only come up with the 9 months. So I'm using a 9-month base so that my base is nice and stable and should be fairly accurate because it's got a large sample size. And I'm comparing it to the current values. And the highest number I'm seeing is 88% in Santa Clara County for Milpitas, Berryessa, Blossom Valley, Santa Teresa. But if you go into Alameda County, they have a 95% and an 89%. Some significant appreciation. You go up into San Mateo County, and basically they're at a 33% appreciation, significantly lower than either Alameda County or Santa Clara County is seeing. The exception is Atherton, Menlo Park. And I don't think that this is rapid appreciation in that area because that wouldn't go along with the long marketing times in that area. What I think this is just the market statistical fluctuation. The homes that have closed in the past 5 weeks are more expensive homes than typical. And again, that would be a fairly small sample size. And so you can get data skewing like that. Now we're looking over the price, and instead of just following the median price as most people do, I follow the median as well as the cheapest 10 percentile in the area and the most expensive 90 percentile in that same area. So very rapidly, using South County as an example, you can see that 80% of the homes are between 820,000 and 1.6 million, with 40% of them being in a $400,000 range from 800,000 to 1.2, and then another 40% being between 1.2 and 1.6. And the fact that both of those ranges is almost $400,000 on the mark is pretty unusual. More common is to see the lower number to be closer together. So we'll come down here and look at Cupertino Sunnyvale. You basically have a $6,000 range for the first 40%, going from 2 million to 2.6 million. And then from the median to the upper, you go from 2.55 to basically 3.3. That is an increase of about 850,000 versus an increase of 550,000 for the first 40. And that's what you'd expect. The bell-shaped curve tends to be more densely populated with the lower priced homes. And then as you get into the higher prices, it's more spread out. So you expect the range, the dollar range for the first 40,000 to be smaller than the range for the second 40,000. But the real goal is to show you the price range that you would expect in every given micromarket area. So here's a summary of what we just went over in the same order. You start over here on the left. And as I was saying, the active listings by itself really doesn't tell you much. That's why we compare it to the 10-year median. And right here, well, let's look at Foster City. I talked about the varying size of my micromarket areas. Foster City only had 2 active listings last night at midnight, where Oakland had 302, a huge range. And these were higher numbers when I did this back in the late 90s, but that's a huge range. And then as far as pending offers, you go from 4 to 189. So again, a huge range in the number, and that's why raw count doesn't work. And that's why for both the active and for the offers, I compare it to the 10-year median. DUI, I'm comparing it to the 10-year median. But here, because it's already a ratio, it's starting to tell you whether the market's faster than slower than normal. So you can see the coast and Redwood City much slower than normal. Most of the other areas are either balanced or favoring the seller. Then you have just the pure DUI, which is the current value, not comparing it to historical values at all. And the yellow up here, these are ones that sort of tell you current market conditions. So if you're looking in this range here, that is sort of the current reductions. And it's sort of a contradiction because if we look at San Mateo County coast, we're showing a 0% of the sellers have adjusted their price, but they've been on the market for a long time. I think what you have going on is the listings that are on have either been the people that have been on for a long time that are stubborn and aren't adjusting their price, or they're the ones that are just new on the marketplace and don't have time to adjust the marketplace. But again, this is only of the successful sellers, where days on market is everybody as well as the total number of active listings. Then you get over to overbidding. And the reason I changed the orange highlight up here is this is delayed. It tells you market conditions, but it's delayed by that 5-6 weeks for escrow. So this is not going to be in sync as you go across each line to your current market conditions. So yellow is current market conditions, orange is historical market conditions, and then you have appreciation and sales price. The concept here is you start over on the right-hand column and find out the monthly payments that you're willing to absorb. And this is calculated using an 80% loan jumbo money. So your actual numbers may vary, but give you an idea, or the price range if you've been pre-approved by a lender, or you can start on the left-hand side in the micromarket area, and whichever side you start on, you then read across horizontally to get a feel for the market conditions in that micromarket area that you would be looking at or considering. Now we're leaving micromarket areas and we're looking at Silicon Valley as a whole. So we're taking those 20 micromarket areas, putting it in a blender, and then just looking at the data overall. So the purple line is your inventory, and it's the lowest line, and it's showing inventory at about 72% of where you'd expect it to be. The orange line is the number of offers accepted over here on the right, and again, it's right at 72%. And then because the number of inventory is below the number of offers on a percentage basis, you'd expect the DUI to be below the expected DUI, and it is slightly, it's somewhere around, I'll call that about 94% maybe of the DUI you'd expect it to be. So you have a faster market than you'd expect with a whole lot of less offers and a whole lot less inventory. And yes, we did have less percentage inventory back here after the pandemic years with a lot more offers, with a lot less activity, which gave you a very fast DUI. But if you compare it, we have almost a DUI that's as fast as it was. Actually, it's a little bit faster than it was in 2020. So we're actually having a fairly fast marketplace considering everything, but we have low number of offers. I think that's the biggest difference is look at the orange line down here. You have low, significantly below the horizontal black line, where in the boom years, we had a lot more offers accepted. So you're way above the level you'd expect. This is again on the same thing, the number of offers. And basically what I wanted to do is point out the actual raw numbers. So our previous record low number of offers accepted was 1,717 offers accepted back in 2008. We're only at 1,444. It's about 270 homes less, almost 20% less. And actually the number should be right here. It's going to be 84% of our previous 25-year low. So I guess that's only 15% of 1770, and it's 70% of the median. It's 3/4 of our 10-year median. So if you only looked at 10 years. So this is when it's dark blue, these are the particular week and year that we were having the record low. Now here, earlier September through October of 2023, we were having the second year. So basically back then, 2007 had fewer transactions, and you can see the numbers 1,500 versus 1,800. So we were selling 20% more homes in 2023 than we were in 2007. Now, again, we're selling a lot less. And basically, most of 2023 was a record low year. I would have to scroll back up, which I can't do quickly, but I think these light blue years were the only weeks that we were the second worst, which is only what, 3, 6, 9, 12. So something like 12 weeks we were the second worst. And then 2 weeks we were third worst probably. And the rest of the weeks out of the entire year, I believe we were the worst out of the last 25. So it's the lack of volume, but you also have a corresponding lack of sellers. So the market stays a fast-paced marketplace. And I think what happened, I think the biggest explanation that makes any sense to me is the pandemic changed everybody's housing needs. And that was why we had so many transactions. Everybody that needed to move accelerated their moves, and now we have a dwarf in just a void in the marketplace where we don't have buyers or sellers. Here's looking at the estimated payments for the cheapest 10 percentile home in Silicon Valley, and you can see that number somewhere around $6,000. The median is somewhere around 11,000, and the 90%, the most expensive, is somewhere around $24,000. Now what we're going to do is each line is a distribution for a 5-week period of time, but we start off moving a month at a time. So we're starting off a year ago at this bold dotted line. We're going to move forward a month at a time from 12 months to 3 months. At 3 months, we go from 3 months, which is 13 weeks, to 12 weeks to 11 weeks. So we go weekly. So there's the market improving, and right there was the peak. Now you can see it slowing down in a summer plateau, and then we're into the fall plateau. And we're 9 weeks ago. That's right at the end of the year, 6 weeks ago. That was the bottom. And now you can see how rapidly we go up. And the purple is this last full week, which is data as of midnight Tuesday, data I gather on Wednesday. And the green line is data through midnight on Friday that I gather Saturday morning. So you can see there's still a big jump up. This is now exceeding the level of the market we saw a year ago. So the market right this year is hotter than the market was a year ago, because a year ago was the dotted line that we started off to, and I don't know exactly where it was, but I think it was way down here. So a year ago, on February 21st, 2023, you were down here as far as the amount of overbidding, and now you're up here. So the number of sellers doing price reductions is reduced fairly significantly. Now we're flipping over and doing the same thing with the amount of overbidding. And again, right now, you're down here. This is where we were a year ago. And then if you see the purple line, it's hard to see, but it's a thin purple line, and I bolded each week, is up here. So again, the amount of overbidding this past week, last night at midnight, is greater than it was a year ago. So the market has improved from a year ago. There we go, rapidly up. That's roughly the peak. And you stay at the peak, it's more stable than your price reductions. And there you can come down. Now you got the fall drop, the end of the year. And there, the purple was basically back right there. And you can see that going from there to there, again, there's a fairly significant increase. Again, we're up significantly from where we were a year ago. So again, the market appears to be healthier than it was a year ago. Now what we're looking at is the components. We're looking at the inventory, and the red line here is less than expected inventory. It's the 10% of the inventory you'd expect. The gray line is the inventory you'd expect, and the blue line is more inventory you'd expect. And the blue and the red change. It's consistent with my coloring of blue favors the buyer, red favors the seller. So in the case of offers, it's going to be the colors are going to be reversed. So what I'm trying to communicate is it's not blue equals more, it's blue equals favoring the buyer, red favoring the seller, and then you have to look at what metric to see if that's above or below. The gray line is always 100%, and it's this gray line that we stretch out on the next slide. So you can see that inventory is basically sort of right at the least, the 90 percentile of the inventory you'd expect for this time of the year. And now this is the gray line stretched out. So you can see that inventory is only 70% of the inventory you'd expect based on the 10-year median. Here is the same thing, but flipping over and looking at offers. So now a few number of offers favors the buyer. And again, look at this little drop from last week to this week. I believe that's directly related to Super Bowl, and I'll try to remember to point that out later, where we have had fewer number of offers accepted, because offers accepted during the past week are from the weekend before, which was when the 49ers were still in the Super Bowl. And now this week, you have more sellers coming on the marketplace, and those sellers are waiting until after this current weekend in order to accept their offers. So I would expect the number of offers next week to start going back up again. And this unexpected dip right here, because you can see the blue line, the gray line, and the red line are normal, solid up. Maybe it's a little easier if you go back 1 year to see they're straight up. So this little dip down is pretty unusual. I maintain that real estate is an optional event that gets impacted by all the social events, and Super Bowl was definitely a social event. Also, I'll point out for the previous slide and for the next several slides, my x-axis when you get to January 1st, 2023 is about double what it is in the historical years. And that's so you can sort of visually see the historical years going back 10 full years. Plus you can see what the trend is for the last year, and then can see today. And that way you can see the current changes. If I was on the scale over here before 2023, this 1 week dip down, I don't think would be as noticeable. Here's the same thing. Now I've stretched out the gray line, and you can see your offers were way below, and you can see that we were going up, and then we had this huge drop. So we dropped almost 10%. We dropped from somewhere around 84% of where you expect to maybe 72%. So I actually got a 12% drop in the marketplace, and I believe that's directly related to Super Bowl. Here's days on sold inventory, and because you had a drop in the number of offers, the DUI actually went up. And again, you can see that historically, because of the historical lines, these are normally coming straight down. So this abrupt up is pretty unusual. Now there's an abrupt up in all of them, but it's earlier in the year, and you can see the abrupt up and the abrupt down, and you should be plateauing. You shouldn't have this big upswing. So that's what happens when you start looking at the micro market data, in this case, Silicon Valley data, on a weekly basis. And we are definitely impacted by the week. If you average that over a month, you're not going to see it, but you're also going to have a monthly impact that the weekly data gets rid of. Here's your days of unsold inventory compared to normal, and you can see we're down around 80%, just under 80%, maybe 78%. So that's saying that we're having a faster market than we normally do. Here's the time on the marketplace. So this is how long is the long typical seller. Same concept. A fast time on the market favors the seller. The gray line is what you'd expect. The blue line is the most time you'd expect on the marketplace. And you can see that you're coming down. This is a little bit more stable because you have to wait for offers to be accepted. You're only looking at the offers accepted. And it's also looking back, how many days was it on the marketplace. And that's why this doesn't move as much the line, all four lines are much more stable than going back here and looking at something like DUI. Here's typical. Now you compare it to the normal, so you're looking at a little more fluctuations. But again, you can see that you're somewhere around 68%, actually maybe closer to 66, 7% of the time on the marketplace you'd expect. So a faster marketplace, which is why you're in the red shaded area instead of the blue shaded area. Here's ask price reductions. So the typical is right up here. That would be completely normal. You're not quite halfway through. You're probably 25% of the way close to the typical marketplace than you are a cool marketplace, but following the normal trends. And this is price reductions of the offers accepted. So we don't have the lag time yet. It looks like a significant difference over here, but this is a very tight scale. From there is 100% to 99%. So that whole thing is only 1%. So you're fairly close together, and that's what this is showing. I don't know what that in percentage is. It's maybe a quarter of 1% is your average price reduction for all of Silicon Valley. And you can see there's been times when they were going over ask price, especially right after the heyday of the pandemic or the recovery. Sellers were going in and actually raising their price because offers were coming in so high, they would be concerned that the appraiser would see the low list price and then appraise the house at the list price instead of the offer price. Here, for this first time, I'm introducing the 10% price reduction. So because price reduction is such a tight metric, I'm looking at only the 10% of the sellers that are taking the biggest price reductions. So I'm ignoring 90% of the marketplace and only looking at the sellers that are taking the biggest price reductions. And you can see it's pretty darn close to the normal. Blue would be more price reductions favoring the buyer. Red is less price reductions favoring the seller. So you can see that even in a hot marketplace, the sellers that are taking the biggest price reductions are taking around a 7% price reduction. Right now, they're taking about a 9% price reduction. This is the same thing. You can see they're taking about a 3% more price reduction than they typically do. Here's the frequency of the seller price reduction. So how common is it? It's right on the normal line. I mean, I can't get closer to that. The gray line disappears for this whole period of time because the purple line's right on top of it. So as far as the number of sellers taking price reductions, it's right where you'd expect it to be. And here you can see you're pretty darn close to 100%. Here's the average overbid. So now this is old data. It's still worth going over because buyers make offers and they want to have some idea of where the market is. Well, it's slightly more. So right now in Silicon Valley, somewhere around 5.5% above ask price is your average. Now, again, that includes those that are going under. It's going to include areas like San Mateo County coast where it's 4.5% under ask price, but it's also going to be taking the hot areas, whether it be Berryessa, Milpitas, or whatever a micro market area it happens to be in. Here's the overbidding. So you can see that you're above normal by a little bit, maybe 1.75% above normal. And that's why it's going towards the red shading. Here's the frequency of overbidding. It's exactly where you'd expect it to. The previous one was magnitude. Now, how common is overbidding? Right, exactly where you'd expect it to be. And when you draw it out, you can see you're slightly above, but that's only a slight bit above. And here's appreciation. This is on log paper. And what, in my opinion, really stands out is this V decline in price at the end of every year. Now, I say at the end of every year, and clearly these are on the new year side of the vertical line. The reason I'm saying that is there's a 5-week delay. So if you're trying to do market conditions, you have to shift this whole x-axis 5 weeks, which would put the new year right about at the center of that line. And you can see we're a little bit earlier. We had a little bit of a U shape. It wasn't as much of a V. But this is more a market shift. It's really not property values. But you can see we're on the steep side of the price incline right now. This now is looking at the three counties that make up Silicon Valley. In the blue, you have Santa Clara County. In the orange, you have San Mateo County, and in the gray, you have Alameda County. San Mateo County is a smaller area, number of homes, and that's why you have fewer inventory. Right now, you can see that historically, Alameda County and Santa Clara can be pretty close together. Right now, Alameda County has more inventory relative to Santa Clara. Offers accepted, the Santa Clara and Alameda County are right on top of one another. They have been for quite a while. San Mateo County, again, is a little bit lower. All three of these are lower than where they'd be historical. You come back to the vertical line, that would be January 1st, move over a little bit, and your inventory would be up here somewhere around 1,100. You're down under 600, so you have roughly half the inventory you'd expect to have at this time of the year. Days on sold inventory, you can see Santa Clara County is the fastest, followed by Alameda County, followed by San Mateo County. You can see all three of these areas, all three counties had an increase, a slowdown in the marketplace basically last week, which I believe is directly attributable to the Super Bowl. Your days on market are plummeting. That's because there's very little inventory carrying over from last year. So almost all the new inventory is what's on the marketplace. And that's showing you, that it decreases, as more and more, as a larger percentage starts with 0 days on the marketplace, the median comes flying down. This is the magnitude of the sellers' price reductions. You can see they peaked out maybe right around the 15th, maybe even earlier in January, around the 10th of January. It's clearly after the new year because the new year is the vertical line. And again, you might argue there's a 1 week delay in getting offers accepted. Most sellers are going to be on the market for a good part of a week. They want to get a weekend in on their marketing activity. Here's the frequency of price reductions. You can see it's plummeting in this time of the year. We have basically less than 10% of the sellers doing price reductions in all three counties. Surprisingly, San Mateo County has the least price reductions. It's gone from the most up here just a couple weeks ago to the fewest in a very short order. I think that's just the steep part of the curve here. You can see they tend to come up on top of one another at that time of the year. Here's the magnitude of overbidding. Alameda County has the most overbidding at 6% over ask price. Santa Clara County next at about 5%, and San Mateo County the least at 4% overbidding. Now, any amount of overbidding is a good thing, but this is not what all sellers are doing. This is just the average. This is the frequency of overbidding. Santa Clara County is in the middle at 60%. Alameda County is the best at 65%, and San Mateo County is the lowest at about 54%. Here's your appreciation. Santa Clara County has the most appreciation at about 78%, maybe 76% appreciation since 2015. San Mateo County and Alameda County are pretty good, right around 61 to 63% appreciation. Here's your sold price. Look how much San Mateo County has come up since the first of the year, where Santa Clara County has been basically flat, and Alameda County went down more than the a steeper V, and it's come up. So the only county that really hasn't come up yet so far is Santa Clara County. Same information on regular paper. Here's those estimated payment in the same order. San Mateo County has the highest payment because it's got the highest price, and it's going up because the price went up. Likewise in Alameda County. Santa Clara County payments are roughly flat because their prices are roughly flat. Here is the breakdown in the numbers, and what I wanted to point out is we had a 10% increase in inventory in Santa Clara County, 4% in San Mateo, 1% in Santa Clara, but the number of offers decreased by basically 4 to 10% in each one of the counties. So you had a decrease in the number of offers accepted because that's left over from the Super Bowl impact, while the number of new listings coming out and went up, which gives you a drop in the DUI of a significant number of from 2 to 4 days. Now we're leaving Silicon Valley and we're going to talk about the Greater Bay Area, which is 5 regions. Here is the numbers. Pick whatever metric you want that you think is most valuable for what you're trying to figure out. This is looking at the inventory. And so if you come back here and just go right after the first of the year, no matter what area you pick, Inventory for Central Valley and North Bay was up here somewhere around 4,200, and now it's at 15. So you have roughly 1/3 the inventory. If you come into Silicon Valley right after you're maybe some number, I call it maybe about 2,200, something like that. And now you're, call it about 1,300. So a little bit above 50%. And the same thing for both Central Coast and the cities. They're all down in inventory, and that's really telling you the picture. The exact number doesn't matter. You're from up here some number to some number down here. That's a dramatic decrease in inventory. When did it really happen? It happened in 2023. Look at that drop in inventory. Here's the number of offers. You can see the offers are down a little bit, but not down as dramatic in my eyes, which may not be perfect, as the number of active inventory. And if offers are not down as much, that's what's giving you the faster marketplace. Here's your days of unsold inventory. You can see Silicon Valley is the fastest. Central Coast is the slowest. The other three are very close together, just over 40 days of inventory. And each county traditionally has its own pattern, and they're stacked up with Central Coast being the slowest, Silicon Valley being the fastest. So we're basically having the same pattern. Here's looking at the time on the marketplace. Again, Silicon Valley is the fastest. Here, the cities is the slowest. Central Coast is the second. So the cities, being San Francisco and Marin, is spending the most time on the marketplace. And Central Valley is in second place. Here's looking at the seller ask price reductions. Silicon Valley is having the fewest, Central Coast and the cities having the most. North Bay and Central Valley coming in third and second place. Frequency of seller price reductions, Silicon Valley having the less, Central Coast the most, the other three pretty close together. And here we have the amount of overbidding for the 5 regions in the Greater Bay Area. Silicon Valley, the purple line, is on the top at 105.5% overbid, so 5.5% overbid. The cities, San Francisco and Marin, is next at just over 4%. Then you jump down to the North Bay at just over 1%, maybe not even 1%. Central Valley is right at the asking price, and Central Coast is at just a smidge below 100% of their asking price. This is the frequency, how common it's overbidding. Silicon Valley is at the most, followed by the cities. The other three are pretty close together. Silicon Valley is at 60%. The three are right under 40%. This looks at total appreciation, and to me, this really tells the downfall of San Francisco. Because if you look historically, all 3 lines were basically on top of one another right until the pandemic in March of 2020. And then from that point on, the cities ended up way on the lower side of the graph versus in with all the others. And the Central Valley sort of bubbled up to the top. What's going on? Well, this is where people would pay a premium to live near where they worked. The Central Valley is where people would have long commutes, and we're willing now to move with some amount of remote working. Silicon Valley came in second just because it's the hub of everything. North Bay and Central Coast were pretty close together. But the 2 takeaways are Central Valley doing exceptionally well and the cities doing exceptionally poorly. Here is the sold price for the different regions. The cities, which is San Francisco and Marin and Silicon Valley, are right on top of one another at 1.5 million. Central Coast is third. North Bay, and the most affordable, which is why people go there for the commute, is Central Valley at just over 500,000. Here's the estimated payment. It's going to be the exact same order because the formula is the same. This assumes a 80% loan and a jumbo rate from about 11,400 maybe down to a low of 4,000, depending on what area, and that's the median price in the different regions. We've been talking about Silicon Valley real estate market, week number 7. These URLs, you type the YouTube URL to get to the channel where all the archives are, or you can just use the tinyurl.com/SVREMG for Silicon Valley real estate market graphs to get there with less typing. If you add in to the green root URL 2024 Saturday morning at 9 a.m., you get to the live presentation. If you add in H for handout 2024-02-17, you get today's handout. I got it up about 10 minutes before the hour, the 9 o'clock hour, which is my goal. And that just allows you to keep it in front of you if you want, if I go too quick on a particular slide. And any past episode, you'd get there by adding in the year, month, date code. I'm Richard Calhoun, Creekside Realty, willing to work with buyers or sellers here in the Silicon Valley. Happy to work with you. The slides that are going on in the background are the slides that we're going to be going over. We start off by looking at the three components: active inventory, offers accepted, and DUI. Because the micromarket area has changed in size, we have to compare that to the 10-year median. We then move on and look at days of unsold inventory just by itself, and you can do that because it's taking the ratio between the supply and the demand in each micromarket area, so size becomes irrelevant. We then look at the 75th percentile on time on the marketplace. That's different than most people that will either quote the average days on market or the median days on market. The reason I went with 75th percentile is median is a very artificially low number because it's just the 50% threshold, and it jumps in day increments at a time. The reason I don't like average is one seller selling after being on the market for a long period of time really skews that average. By looking at the 75th percentile, you get a number that moves like the average, so it's more sensitive than the median, but isn't impacted by what one or two sellers do. It requires 25%. Three-quarters of the sellers are able to sell in less time than that. 25% of the sellers take longer than that. I then also look at price reductions, which nobody else that I'm aware of looks at. What magnitude of price reductions are and what frequency are those price reductions. On magnitude, I focus on the average, but I also look at the 90 percentile or the 10 percentile of the sellers that are taking the biggest price reduction. The reason I look at just that 10% is a large percentage of the time, most of the sellers are doing no price reductions, so that minimizes the impact of any change in the marketplace. By looking at the extremes, which you normally don't do on a statistical analysis, you can see what's happening in the marketplace. So I look at both the average and what the sellers that are doing the largest 10% price reduction, what they're doing. I look at the frequency. How common are those price reductions? As it becomes more and more common, that indicates that the seller's expectations were higher than what the current marketplace is. I then flip over and look at the overbid. I know I have a lot of competition with other people looking at overbidding, but the disadvantage of overbidding is you have to wait for those escrows to close. It also groups transactions together based on closing dates, not based on when the offers were accepted. So there's a 5 to 6 week lag time, and it's grouping transactions together in wrong groups. You want to know what the grouping was back on the day the offers were accepted. You want the data as quick as you can. That's why I introduced the frequency and magnitude of seller price reductions. I then also look at the long-term price appreciation. Almost everybody focuses on year-over-year price appreciation. I took a 9-month period of time from April 1st, 2015 through December 31st, 2015, the last 3 quarters of 2015, and I'm comparing the price appreciation today to that mark. Then on sold price, in addition to following the median sold price that most people do, I follow the 10 percentile and the 90 percentile. That gives you some idea in each micro market what range of pricing to expect in that given micro market area. I also look at not only the 20 micro markets within Silicon Valley, I look at the Silicon Valley as a whole so you can get a broader view. I also then look at the 3 counties, Santa Clara County, Alameda County, and San Mateo County individually, so you can see how right now San Mateo County is doing significantly worse than Santa Clara and Alameda County. Again, I think that's directly related to the pandemic. I also show the raw numbers so you can look and see the numbers yourself. Once we've gone through that, we leave Silicon Valley and we look at the Greater Bay Area. The Greater Bay Area includes 5 regions. The first one is Silicon Valley, which is Santa Clara County, San Mateo County, and Alameda County. I then add in the cities, San Francisco and Marin, then North Bay, Sonoma, Solano, Napa, and Contra Costa. I then enter in the Central Valley, San Joaquin, and Sacramento, the 2 big counties out there that people commute into Silicon Valley from. And lastly, we look at the Central Coast, which is Monterey and Santa Cruz. The reason you want to look at these regions is typically the market starts shifting from Silicon Valley and bubbles outwards, but every once in a while, and I think it was 2005, the ripple went out and basically hit Sacramento, and then Sacramento started collapsing and coming back onto Silicon Valley. By watching those 5 regions, you get an idea of how widespread the health of the marketplace is, and you get those earlier reductions. Here we are back to the URLs. Thanks for joining. Have a great week.